This is Nightly Business Report with Bill Griffith and Sue Herrera.
Taxing decisions. States can start collecting billions of dollars in sales tax from internet retailers. And the landmark Supreme Court ruling ripples through Wall Street.
Forced out, Intel CEO resigns after mixing business with pleasure, and shares fall.
Modern medicine, a different kind of prescription to control diabetes. Those stories and more tonight on Nightly Business Report for Thursday, June 21st.
And good evening, everyone. I'm Contessa Brewer, in tonight for Sue Herrera.
Hi, Contessa. I'm Tyler Matheson, in tonight for Bill Griffith, coming to you from New York City. Well, there was a big decision today from the nation's highest court, but also a big day on Wall Street, and that is where we begin tonight. Stocks fell sharply as trade tensions lingered after the U.S. Commerce Secretary said more pain was needed.
What we have to do is create an environment where it's more painful for these parties that have these huge trade barriers, both tariff and non-tariff. Got to make it more painful for them to keep those barriers than to get rid of them. And that's a lot of what all this exercise is about.
And that dragged investor sentiment lower and pushed the blue chip Dow index down for the 8th straight session. That's its longest streak, losing streak that is, since March of last year. The selling was broad, hitting everything from industrials to tech shares. The Dow Jones Industrial Average off 196 points to 24,461. NASDAQ down 68, and the S&P 500 dropped 17.
A Supreme Court ruling could drastically change the online shopping industry. The justices overturned a 26-year-old decision that effectively barred states from imposing sales taxes on out-of-state purchases. The decision was a big win for South Dakota, which had asked the court to uphold a recently passed law imposing an internet sales tax. But it's considered a loss for Amazon and other online retailers, which saw their shares fall in trading today. Courtney Reagan has the details.
The U.S. Supreme Court now says retailers should collect online sales tax from consumers, even if the retailer doesn't have a physical presence in the buyer's state. Today's ruling is a reversal of the decision the Supreme Court made in 1992, mostly looking at catalog shopping before online shopping became a daily reality. Explaining today's decision, Justice Kennedy writes, quote, "The internet's prevalence and power have changed the dynamics of the national economy." However, Chief Justice John Roberts and 3 other justices agree the court got it wrong 26 years ago, but say it's Congress's job to fix it. Large retailers like Macy's, Home Depot, and Best Buy have been in favor of online sales tax collection across the board and count today's decision as a win.
I think it's about a decade too late, but I think it's the right decision. The internet has had an unfair comparative advantage against stores for a number of years, and it's really hurt Main Street, it's hurt large retailers, and it's just leveling the playing field. I think it's the right thing to do.
It's good news for state budgets. The Government Accountability Office estimates state and local governments lost up to $13 billion in uncollected online sales tax last year alone. However, many smaller businesses that sell on their own websites or on a marketplace like Amazon, eBay, or Etsy aren't happy. While Amazon does collect sales tax on items it sells, more than half of what's sold on Amazon is sold by third-party sellers. These merchants aren't always collecting sales tax because until now, it hasn't been required by law. Etsy CEO Josh Silverman says the decision isn't what his company wanted, but adds, quote, "We urge Congress to thoughtfully consider today's decision and to act swiftly and in the best interest of the micro businesses they represent." Now retailers of all sizes will need to invest in systems that allow the collection of sales tax in thousands of U.S. jurisdictions. Most retail experts don't believe the decision will change which merchants consumers buy from online in a significant way because of other factors like convenience. Though consumers may think twice in some cases, particularly with high-priced purchases not previously subject to online tax. For Nightly Business Report, I'm Courtney Reagan.
Well, let's talk now about what this Supreme Court ruling could mean for consumers and the retail industry. We're joined by Arun Sundararajan with New York University's Stern School of Business. Arun, welcome. How soon will consumers potentially feel the bite of today's ruling?
Well, I think they're going to start seeing it very soon, especially if you shop through retailers like Etsy or Wayfair. I think Wayfair is probably one of the biggest losers here. They are a site that advertises themselves as a place where you don't have to pay sales tax. Amazon's probably going to see some impact, but they are big enough to be able to absorb any losses that come from their sellers having to charge sales taxes. So this certainly sort of shifts the power in the online retailing space away from the smaller players and towards the bigger players.
And Arun, talk a little bit about why previously bricks and mortar traditional retailers like Macy's and Best Buy would be so supportive of this, because after all, it's going to add to their administrative costs collecting sales tax from coast to coast, isn't it?
Well, it's because a lot of the bricks and mortar retailers don't have a significant online presence relative to their bricks and mortar presence, and they have the systems in place to collect sales tax anyway. And so they're probably seeing it as a small victory as they're facing the online retailing onslaught. But while it certainly works in their favor in the short run, it's certainly not going to be a big enough change to sort of save them from the tsunami that has been building up, and that is going to wash over their business models over the next 5 years.
You know, Arun, it occurs to me that beyond the fact that a small retailer is going to have to charge and collect 8% sales tax or whatever it is in whatever the jurisdiction, but it is also going to raise that small retailer's cost of doing business if they have to buy software systems to help them comply, and then they're going to have to, one way or another, remit those collections back to the taxing district where the consumer lives. How much is it going to hurt them?
Absolutely. I think that it's going to cause a lot of small sellers to try and attach themselves to larger platforms that offer this service. It would be in Amazon's best interest to sort of handle or shoulder some of this burden for the millions of sellers who sell through their marketplaces, but it also forces and locks in the smaller seller more and more into a big platform like that. What I'm hoping will happen is us seeing Congress carve out space in this, in these regulations that imposes a high enough minimum sales, only above which you're going to have to pay sales tax. And so if they say, unless you make $1 million or more in sales, this does not apply to you, this would certainly protect a lot of the micro businesses that sell through Amazon or sell through Etsy.
Arun, is there any bigger winner here than the states?
Really, the states are the big winners. Consumers are supposed to be paying these taxes on their own. It's just that they don't do it. And so states have a way of sort of reducing the volatility of their budgets. But in the long run, things are going to even out. And, for the large retailers who might be celebrating this as leveling the playing field, it's certainly not enough to sort of for them to sort of counter the online retail sort of juggernaut that is going to steamroll a lot of their business models in the years to come.
So, Arun, I'm shocked that you don't think consumers are already paying this voluntarily. I
guess my faith in humanity is not as high as yours, Tyler.
All right. Arun Sundarajan with New York University Stern School of Business. Contessa.
Thanks.
Well, Intel was one of the worst performing stocks on the Dow index today after its CEO abruptly resigned for violating company policy. Intel also raised its profit and revenue forecast for the second quarter, but investors just focused on the departure of its chief executive. And that's what Josh Lipton is looking into tonight.
A shock for Intel and Silicon Valley today. The company removed its CEO, Brian Krzanich, saying he had a consensual relationship with an employee. That violates company policy, which says managers can't have relationships with people who report to them either directly or indirectly. It's unclear with whom Krzanich had the relationship, but it ended some time back, sources tell CNBC. The company only recently learned of all this, at which point it launched an investigation investigation and took action. In a filing today, Intel said Kruzanich is entitled to a $38 million walkaway payment in the event of a voluntary termination. An Intel spokesperson didn't immediately respond to comment about whether Kruzanich will receive that payment. Kruzanich was an Intel veteran. He joined the company back in 1982 and became CEO in 2013, where he broadened the chipmaker's reach beyond the PC and the data center and into artificial intelligence, the Internet of Things, and self-driving cars. Analysts say he gets credit for a stock price that rose about 120% under his watch. CFO Bob Swan has been named interim CEO, but who could replace Kruzanich permanently? That guessing game has already begun.
Certainly the last time we saw something like this, it was Hewlett, but when Hewlett went through it, things were not good at the company. And you had a lot of high-end talent that people wanted to get the job, like Kathy Lejak, that didn't. And I think we've seen Hewlett suffer from the fact that they didn't have a good leadership succession, in place. So I think they need to look inward, and I think they need to kind of make sure that the street knows that it is business as usual at Intel.
Some say the candidate to watch is Murthy Randuch-Intala. He's Intel's chief engineering officer, an executive well engaged in growth markets like 5G and the Internet of Things. And it's those growth areas that Wall Street wants the next CEO to focus on. For Nightly Business Report, I'm Josh Lipton, Santa Clara, California.
Well, just as today's market decline is being pegged to lingering trade tensions, new research shows that trade is also the reason behind the market's recent bout of volatility, and investors are paying attention. Steve Leisman looks at the ups and downs.
For a president that has otherwise been friendly to business and stocks, new research by CNBC shows Mr. Trump's trade policies have cost markets hundreds of billions of dollars and created head-spinning volatility. There have been 35 moves of 1% or more in the Dow Jones Industrial so far this year. CNBC found fully a third of these moves related to news on trade. On 7 of those 12 days, the Dow fell an average of 1.7% and cost investors a cumulative $700 billion in market capitalization. But in 5 of those instances, on news that trade tensions were easing, stocks bounced back, restoring $560 billion in value. So how does it all net out? Trade ends up being a net negative and looks to be one big reason stocks are flat this year, even amid strong GDP and job growth, along with the president's profit-friendly tax cuts.
Markets are going to have to account kind of a couple of steps ahead when it comes to the trade disputes with the EU, the trade disputes with China. And when you start adding up those effects, while they might be small on an individual basis, very quickly you offset the fiscal stimulus that you got from tax cuts and spending increases. We think that was baked in the markets at the end of last year. So, negative trade news should be negative market news now.
The research shows the companies taking the biggest hits from negative trade news are household name stocks deeply involved in world trade. They include Caterpillar, Boeing, 3M, and Dow DuPont. Even big financial stocks like Goldman Sachs and JP Morgan end up being hurt when trade news comes over the tape. Among the biggest drops, on March 22nd, President Trump announced $60 billion in tariffs on China. Markets plunged nearly 3%. But 4 days later, the Dow surged 2.8% after a Wall Street Journal story said the U.S. and China were quietly negotiating to improve trade, an improvement that never came. It's worth pointing out, we could not find a 1% positive move or higher linked to any news that tariffs would be increased. That's a pretty clear sign equity investors don't see the economic upside from higher tariffs or a trade war. For Nightly Business Report, I'm Steve Leisman.
It's time to take a look at some of today's upgrades and downgrades. Shares of Nike were downgraded to neutral from buy at UBS. The analyst says the market's upbeat outlook is already priced into the stock. The price target is $78. Shares fell 1% to $73.94. Verizon shares were upgraded to buy from neutral at Goldman Sachs. The analyst says the stock has been unfairly punished, falling about 7% so far this year. The price target is $56. Shares rose 1% to $48.63. Ty.
And that same Goldman Sachs analyst, busy day for that person, upgraded shares of Charter Communications to buy from neutral. The analyst cites strong network assets, a large customer base, and strong financials. Price target now $361. The stock closed the session at $291.86. And AMC Networks was downgraded to underperform from market perform over at Bernstein. The analyst there says it's unlikely that AMC will be acquired at a premium and that investors hoping for a takeout will be disappointed. The price target now $59 a share. The stock fell 3.5% to $65.02.
Still ahead, OPEC's big decision.
I'm Brian Sullivan in Vienna, Austria. Coming up next, why a decision to actually raise oil output may also raise oil prices. That's next on Nightly Business Report.
The 35 largest U.S. banks have all cleared the first part of the Fed's annual stress test. The stress test is conducted to ensure that banks would be able to maintain enough capital during times of extreme stress. The central bank introduced the test following the financial crisis. The results of the second part come next week.
The world's biggest oil producers are nearing a deal to lift oil production, and if that happens, it has the potential to change the dynamics of the energy markets. But such a deal is very complicated, and oil prices today struggled for direction, ultimately settling slightly lower, as you see there. Brian Sullivan is in Vienna tonight.
It's looking more and more like President Trump will get his wish, and OPEC will pump more oil in the months ahead. That's the takeaway from day 2 of the OPEC conference in Austria. Tomorrow, right here, the world will be watching as the cartel will make its official announcement of how much oil it plans to add to the global markets, reversing a 2016 decision that reduced output by more than 1 million barrels a day. OPEC Secretary General telling CNBC that he is confident a deal will be reached.
I am optimistic that our conference on Friday, tomorrow, with OPEC, and then OPEC and non-OPEC on Saturday, will come up with a consensus decision.
The question many have is why Saudi Arabia would want to pump more oil when it's perceived that higher prices are better for their country. Oil expert and author Dan Yergin says that it was likely pressure from the Trump administration that pushed the Saudis to demand more output.
The relationship between Saudi Arabia and the United States now is very close. It's a much better relationship than it was under the previous administration. And I think both sides want to see that relationship continue to be a basis because it's very much at the center of the Middle East strategy of the Trump administration.
But even an agreement to raise production may not be enough to keep oil costs from rising, because sanctions on Iran, as well as Venezuela's continued economic disaster, mean more than 1 million barrels per day may still disappear from the market this year.
In the back half of this year, even if OPEC exhausted its spare capacity right now, which is about 1 million barrels a day, we're still going to draw inventories in the third and fourth quarters. That means higher prices.
Which also means both OPEC and President Trump could come out ahead. OPEC gets to pump more oil and also make more money. And the president looks like he's applying pressure to help the American consumer. For Nightly Business Report, I'm Brian Sullivan, Vienna, Austria.
So what's in the cards for tomorrow, and how does the decision here impact oil prices? We're joined by John Kilduff, who's the founding partner at Again Capital. First of all, what are you reading in the tea leaves about what the official decision will be tomorrow?
From comments made this evening by the Russian oil minister and Saudi Arabia's oil minister, the decision has been made to make a 1 million barrel per day boost in production. Will there be enough supply? This will help a lot. But demand is robust and strong, and that's why they're doing it now for this third quarter, where we see a lot of fuel demand from summer driving here in the United States and around the world. So it's an important move, and it looks to have really undercut the price rally that was going on just a few weeks ago.
You know, John, do you subscribe to the analysis in the piece just a moment ago that we could get the million barrel a day increase in production, but that prices could go up as well?
It bears watching, Tyler. I am not that constructive on prices as that gentleman was in the piece, but we are in a deficit situation. But I think this is an important move by Saudi Arabia. Saudi Arabia has 2 million barrels of spare capacity in and of itself. So they are trying to be generous and spread the wealth around here a little bit, even as the Iranian barrels go offline here from the U.S. sanctions. The wild card there, Tyler, is that does a country like China, who doesn't care about the U.S. sanctions or the implications from the U.S. banking system problems, still step up and fill the gap and buy that Iranian oil? So it's not a certainty at all that all of that oil, or several 100,000 barrels worth of it, gets lost.
You're dealing with instability in Venezuela, in Libya, in Iran. Can the Saudi increase counterbalance some of that when you're dealing with growing demand in places like China and India?
Right now it has. Right now this has sent a big signal to the market that while the Saudis contemplated just about a month ago that they were thinking about letting prices float up to 85 to 100, they got the message from Donald Trump, they got the message from India, they got the message from China too, that this is hurting their economies and their demand. And the Saudis have come to realize that the customers, this is their word, are very important to this mix as well. So that's why they're addressing this now. So this is a good start. They may have to do more. They likely will do more, Contessa.
And John, the Russians go along with this because?
Well, they are happy as clams, Tyler. The Russian oil companies never wanted to be part of this program. They had to follow the lead of their President Putin. But they want to be like our U.S. shale players, our U.S. oil companies. They want to keep producing and growing and putting more oil on the market and getting more market share. So they are happy as clams to be adding more oil now.
What do you expect for gas prices?
They have peaked for the summer. They should continue to trend lower. We'll see about what happens in the fall when everybody goes back to work and school. They could pop up a little bit again, but we should see the national average trend down to around $2.55 to $2.70 a gallon.
John Kilduff with Again Capital. John, thank you so much for adding your expertise.
Thank you very much for having me.
Well, Kroger's investments are paying off, and that's where we begin tonight's market focus. The grocery store topped earnings and revenue estimates, increased spending on its digital operations. That led to a sharp rise in online sales. Kroger also raised the low end of its full-year profit estimates. Shares finished up nearly 10% on the session. It was a down day overall to $28.73. Best day for Kroger in 9 years. Darden Restaurants said an increase in customer visits helped sales rise at a faster than expected clip. The owner of Olive Garden, Longhorn Steakhouse, also beat earnings expectations and said it sees same-store sales rising as much as 2% this year. Shares up more than 14% to $107.06. But it was a much different story today at Barnes & Noble. The bookstore chain reported a wider than expected loss and disappointing revenue as weaker same-store sales hurt results. Shares were off almost 4% to $6.20.
ConAgra Foods is reportedly interested once again in merging with Pinnacle Foods. Several reports say the two companies are once again in talks 1 year after initial conversations fell apart. A potential deal could create the second largest U.S. frozen food company. Shares of Pinnacle rose 2% to $66.01. Meanwhile, ConAgra shares were off a fraction to $38.28. Shares of Stamps.com took a nosedive today after the White House said it wants to restructure the U.S. postal system to create a sustainable business model. The U.S. government said it also would consider turning the business into a privately held operation in the future. Shares of Stamps.com fell 10% to $251.85. And after the bell, software company Red Hat topped both earnings and sales expectations, but it was the company's guidance that worried investors. Red Hat expects results in the current quarter and the full year to miss street targets. And so, as you might expect, shares initially sold off in after hours. They ended the regular day down 2% to $165.73.
Coming up, Defeating Diabetes, a new program that can improve health and curb costs.
Spending on medicine to help control diabetes is on the rise, but a new program is helping lower the cost while at the same time improving patient health. The idea is relatively simple. Meg Terrell has tonight's Modern Medicine.
Rita Perkins has lost more than half her body weight. By walking more, she lost 100 pounds, but the scales stuck there as she couldn't kick unhealthy habits, and Perkins struggled to control her diabetes. Then she received a different kind of prescription, a prescription for fresh, healthy food.
We're standing in the fresh food pharmacy at Geisinger Shamokin Hospital.
Oh, hi
Rita.
Hi.
Hi, come on in.
Perkins is part of a new program at Geisinger Health System designed to control type 2 diabetes in low-income patients. Not with more medicine, but with food and education.
In healthcare, we spend an awful lot on drugs and devices because it's business, but we spend a very small amount on preventive medicine. It's sort of like we're upside down and backwards.
Well, I guess I better get some peaches.
The program has resulted in dramatic improvements in patients' health, from cholesterol to weight loss to blood sugar. Some have been able to reduce use of diabetes medicines, and it saves money too.
Financially, we've seen probably a decrease in healthcare claims paid out on our Geisinger patients by over 2/3.
This is the plate I used to eat on. Now I am down to this size of a plate.
Perkins receives 10 free meals a week for everyone in her household. She says the program helped her drop another 45 pounds, and it's also setting a new path for her family.
I know they're learning to eat the healthier way than what I was.
With 100 million Americans estimated to have diabetes or pre-diabetes, use of medicines has been on the rise. Prescriptions rose 18% between 2013 and 2017, while spending on U.S. diabetes medicines more than doubled to $54 billion. But programs like Geisinger's, which the health system plans to expand, may help make a dent. For Nightly Business Report, I'm Meg Terrell.
You can read more about this program to help control diabetes on our website, nbr.com.
And before we go, let's take another look at the day on Wall Street. It was a down day. The Dow off 196 points, NASDAQ down 68, and the S&P 500, folks, dropped 17.
That's Nightly Business Report for tonight. I'm Contessa Brewer. Thank you for watching.
And thanks from me as well. I'm Tyler Matheson. Have a great evening, everybody, and we'll see you back here tomorrow night.